You are listening to Keystone Stock Talk Podcast, episode 48. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week in our Your Stock Our Take segment, we take a look at Strongco Corporation, symbol SQP on the TSX, a distributor of new and used equipment for the infrastructure, construction, mining, oil and gas exploration, forestry, and industrial markets within Canada and the U.S. After a strong Q2, a listener asked us if its turnaround is now on and whether it is a buy, sell, or hold. Our star of the week is Parkland Fuel Corporation, symbol PKI on the TSX, Canada's largest and one of North America's fastest growing independent suppliers and marketers of fuel and petroleum products, and a leading convenience store operator. The stock has surged 49% year to date and 16% in the last week alone. It should be no stranger to our clients and listeners, having recently been a re-recommendation in our Canadian income stock research in the $28 range. This week, it closed in the $40 range. Finally, our dog of the week is Maxar Technologies, symbol MAXR on the TSX, an integrated space and geospatial intelligence company with a full range of space technology solutions for commercial and government customers, including satellites, Earth imagery, geospatial data, and analytics. The stock has fallen 25% in the last 2 weeks alone after reporting a quarterly earnings miss. Is it a dog or an opportunity? Now let's dig into the show. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We had a tweet come in from Riley, who asks us, do you think Strongco Corporation is a company that is turning around operations? Your thoughts on the turnaround, how it's progressing, and is it a buy at present? Well, Strongco Corporation, symbol SQP on the TSX, currently trades at around $2.60. Its market cap is around $35 million, so it's a micro-cap situation. What does the company do? Well, they sell and rent new and used equipment to companies operating in infrastructure, construction, mining, oil and gas exploration, forestry, and industrial markets in Canada and the U.S. Their primary distribution product lines include Volvo Construction Equipment North America and Case Corporation Equipment and Manitowoc Crane Limited. So cranes through that, distributing their crane products. Some key points here. The stock is up 30% year to date and 12% over the last 2 weeks. What is driving it? The company came out with very strong quarterly numbers for the second quarter. Revenue increased 21% to $122 million. Earnings were the real story here. The company grew earnings to $1.6 million or 13 cents per share from a loss of about $500,000 in the prior period. EBITDA was up around 97% to $7.3 million in the quarter. So very good numbers. Now, the most recent quarter for the company amounted to only the third quarter in the last 3 years that the company has managed to be profitable. This is not the best recent track record, but on a positive note, the other 2 profitable quarters were both within the last 12 months. The company has a seasonal business. Generally, business activity follows a weather-related pattern of seasonality. Typically, the first quarter is the weakest as construction and infrastructure activity is constrained in the winter months. This is followed by a strong gain like we saw in the second quarter as construction and other contracts begin to be tendered and companies prepare for summer activity. Third quarter generally tends to be slightly slower than the second from an equipment sales standpoint. It's partially offset by continued strength in equipment rentals and customer support activities. And the fourth quarter activity generally strengthens as customers make year-end capital spending decisions and exercise purchase options on equipment, which has previously gone out by RPO. In addition, purchases of snow removal equipment are typically made in the fourth quarter, so there's some strength there. Now, our take. Strongco is a distributor with a relatively low margin business. The company operates in a cyclical and seasonal business and is subject to very lumpy quarterly results. It also possesses relatively high debt levels, although it's working on that. In other words, it is a high-risk and unpredictable business, likely not suitable as a long-term buy and hold situation. On the bright side, the last quarter was strong. Management is in cost control mode. The business is turning around in some respects. At least they're focusing on cost control. And the overall market for heavy equipment across Canada is expected to show continued improvement in 2018. Management remains cautiously optimistic regarding the outlook for the remainder of 2018. There will be some one-time costs with some restructuring in the upcoming quarters, but again, those are one-time. For us, the company does not have consistent enough of an earnings profile to rank as a buy in Keystone's research, but it may continue to show some midterm strength due to the strength in its key end markets, including energy. It is not a long-term buy. You may look at it as a high-risk trade if you believe higher energy prices and near-term spending in infrastructure may increase. Now we move to our weekly star. From our Stars and Dogs segment, it's time for this week's Star. Parkland Fuel Corporation, PKI is its symbol on the TSX. It closed the week in the $40.25 range, has a market cap of about $5.32 billion. It is no stranger, again, to our clients as it was re-recommended at the $28 range earlier this year. Our original buy on the stock was around $17.25. So what does the company do? Parkland is Canada's largest and one of North America's fastest growing independent suppliers and marketers of fuel and petroleum products and a leading convenience store operator. What is driving the stock? Well, what drives most companies long-term is earnings, and this company had tremendous Q2 earnings growth. When it reported those, the stock jumped almost 9% right when it started trading the next morning this past week. Now, revenue in the quarter was up over 109% to $3.78 billion. Net income came in at $60 million compared to a loss of $1 million in the same period, so that's 45%. On the positive side, it earned 44 cents, in the quarter, up from a loss of 1 cent in the same period last year. Adjusted EBITDA was up 361% to $249 million in the quarter. The results in the second quarter continue to highlight the contribution of the Chevron and Ultramar acquisitions, the significance of the annual synergies that the company is realizing right now, and the underlying strength of Parkland's pre-acquisition operations. Through these acquisitions, Parkland has established a significant Canada-wide scale that enables strong opportunities for continued organic growth. The company's growth in both revenues and earnings have been significant in the last year. Its portfolio of brands continues to grow, adding the Chevron and Ultramar businesses to the existing portfolio that includes Esso, Fast Gas, Pioneer, and they place the company in an increasingly prominent position in the Canadian fuel market. The company's very strong gains over 2018 and its strong quarterly report have earned it the coveted distinction of Keystone's Star of the Week. Now we move to our weekly dog. From our Stars and Dogs segment, it's time for this week's Dog. We close with Maxar Technologies Limited, symbol MAXR on the TSX. Trading this week, closing around in the $49.93 range. Its market cap is around the $3 billion range. What has led to its dog performance here over the past 10 days? The stock 10 days ago, July 30th, was trading around $67, and it's dropped to the $48, $49 range. Well, they came out with a Q2 earnings miss that investors were not expecting and turned into a net loss for the first time in around 2 years. Let's look quickly at what the company does. Maxar Technologies is an integrated space and geospatial intelligence company with a full range of space technology solutions for its commercial and government customers, including satellites, Earth imagery, geospatial data, and analytics. Those weaker than expected Q2 2018 earnings the company lost $18.6 million compared to a gain of $19.3 million in the same period last year. On a per share basis, it lost 33 cents as opposed to a gain of 52 cents in the same period last year. Despite this, revenue growth was actually strong in the quarter. Revenues were up 54% to $578 million, and adjusted EBITDA was up 159% to $171 million compared to $66 million in the same period. However, adjusted EBITDA dropped from the previous period, or the Q1 period, where it had come in at $187 million. So there was a drop from Q1. It is the only quarter to report a net loss in the last 2 years, and the market did not like it. Despite this, management is reaffirming its full year 2018 guidance for revenue, cash flow from operations, and its full year adjusted EPS outlook. So they are reaffirming that despite the loss in the quarter. In terms of year-over-year growth, the company's revenue growth and EBITDA growth actually look fairly decent. The dip in net income is mostly due to reported depreciation and amortization that is 6 times higher than the same quarter in the previous year. Despite this negative income, the company is seeing good operating cash inflow. Nevertheless, revenue being unable to keep up with the non-cash expenses have dipped the company into a net loss position, leaving investors unimpressed and making this company our dog of the week. I do note that while revenue growth was strong in the quarter, the growth overall in revenues for the past 5 years from the business has been less than spectacular. And the debt load on this business right now is relatively high. That's going to close it out for this week. I again thank our listeners for submitting questions via Twitter, via the regular social media channels, and via email. Keep those questions coming into our Your Stock, Our Take segment. We're getting more and more, like I say, every week, which is great to see. And again, I'd like to wish our listeners profitable investing.